And welcome to an overview of the ARA private funds business, covering both private real estate and infrastructure. My name is David Blight. I'm the CIO for the private funds business. I will address the real estate activities of private funds, and my colleague Kanishk Bhatia will present the infrastructure operations. Our presentation today is in three clear sections. First, an overview. We'll provide a high-level summary of the business, the type of funds that we operate, and a few examples of deals that we've done in recent times. Secondly, we'll touch, as others have, we'll touch on the themes and the outlook for the markets in which we operate, both equity and debt markets. And finally, we'll finish on our key priorities for the balance of this year. So turning to the overview of the platform, the private funds business is active across five clear, distinct jurisdictions in the region: Australia, New Zealand, China, Southeast Asia, Japan, and South Korea. The business collectively manages in US dollars 15.3 billion in assets across 25 closed-end private institutional vehicles. Last year, we transacted on over 2.3 billion of assets, and we raised a total of 1.4 billion of equity. Importantly for the platform and for our team of 70 people, we now enjoy the support of over 600 investment and support professionals from within the broader ESR group, as well as getting access to the group's extensive networks. The entire platform comprises 25 closed-end funds, of which 22 are fully invested and 3 are in acquisition mode. The combined portfolio is spread across the various sectors you can see there, including office, retail, infrastructure, residential, and hospitality. Our strategy is focused on expanding into the real estate credit space. Now, this is a natural step for us, given our deep roots in the real estate investment management in the region. And in addition, we're in the process of securing managed accounts for both debt and equity for China-based insurance companies, as well as broadening our presence in Japan. And finally, we plan to recapitalise selected funds in the coming year as markets begin to stabilise, and in order to be in a position to acquire high-quality assets at what we think are attractive risk-adjusted prices in selected sectors. Here are the 4 key pillars on which the private funds business is based. The first is our sponsorship. As part of the ESR group, we're now looped into an extensive deal network, as well as having access to best-in-class industrial and logistics expertise, as you've heard through the day. In addition, ARA maintains a strong presence in the region that's been built up over our 21-year history, and with our rather unique investor operator model, provides a very intensive asset management program, and ultimately, in our view, provides better outcomes for investors. In real estate, our sector focus remains on office, industrial, retail, residential, and hospitality across the core to value add spectrum and in all parts of the capital stack. This is what we've done historically. We stick to what we know, and that's served us very well over the journey. The third pillar, our people and our partners set us apart. We have a lean, flat, deeply experienced management team with access to the group's investment management and support teams, together with capital partners representing nearly half of the world's top 20 investors. And finally, and importantly, to attract and retain these investors, we have to continue to offer a range of investment solutions. We have to originate new investment opportunities, and most importantly, we have to deliver on our underwrite. Here we profile a selection of our capital partners. I won't dwell on this slide, but suffice to say we're incredibly proud of the company we keep. Turning to a sample of what we do in private funds, these are 3 deals, and I'll touch on each of them. 61 Robinson Road in Singapore was an asset we acquired right before the pandemic, making the execution of the refurbishment program all that more challenging. But the team was able to ultimately deliver on the project and trade out of the asset less than 2 years later with a 16 IRR for investors, and importantly, taking the building from 0 energy rating and very limited ESG attributes to a Green Mark Gold certification. Similarly, with Lazada 1 in Singapore, the asset was acquired in early 2019 with a plan to reposition and modernise the building. The team progressively undertook the refurb and leasing program, taking the occupancy from 30% to 98% where it sits today, and the weighted average lease term to expiry, originally 1 year, is now 5 years. And the new tenant profile here is deliberately tilted to new economy tenants in order to enhance the security of the income for our investors. And finally, for 200 Victoria Parade in Melbourne, here we acquired the site and funded the development of this 10-level office building with ground floor retail and parking on behalf of an institutional investor. The demolition and construction program was pretty challenging. It ran through the severe Melbourne lockdowns between 2020 and 2022. Pleased to say the building reached practical completion recently with over 95% of the net lettable area committed, with a weighted average lease term to expiry of 10 years. Again, importantly, we achieved a very high energy performance rating of 6-star NABERS, 6-star Green Star, and Gold WELL ratings. All 3 of these projects are not only examples of how we go about adding value to real estate assets, but more importantly, how we go about future-proofing the buildings for the new world order. So moving to the key themes that we're seeing across the region in the real estate space. So we're now seeing very clearly the impact of sharp rises in interest rates and the cost of debt biting on both market confidence and asset pricing. Equity investments in the real estate space remain very challenging as price discovery slowly emerges in most of the mature markets, and capital remains fairly cautious, but there is capital available for distressed or emerging sector opportunities where the downside risk is limited. Refinancing activity is increasing as traditional banks tighten their lending criteria and investors manage their ICR and LTV positions. And this is giving rise to credit opportunities, particularly in China, Korea and Australia, where equity style returns can be achieved from pretty much a senior debt position in the capital stack. Fourth, the Japanese market is attracting significant interest. It's the 3rd largest economy in the world. Inflation seems to be subsiding, economic growth is sound, and a relatively weak currency, all being supportive of asset acquisitions, particularly in logistics and multifamily. And finally, a theme that we're hearing more of through the region is a strengthening trend in multifamily as populations continue to grow, high levels of urbanisation continue, and migration levels return to pre-pandemic levels, particularly in Australia. Geographically, for China, ongoing geopolitical tensions are making it difficult for China to attract any meaningful real estate foreign investment, but local capital is beginning to activate. The recent zero COVID policies also had quite an impact, particularly on the retail assets. but we now see that mall traffic is now getting underway and starting to increase. In Singapore, as a destination for capital, Singapore continues to be attractive, although some short-term pricing does exist due to the sharp rises in debt costs. Many are seeing this as an opportunity to acquire good quality assets well in a market that's got very strong mid to long-term prospects. In South Korea, price discovery is pretty well advanced. Some pockets of distress are beginning to interest capital partners, and we do expect some high quality opportunities in this market in the short term. In Australia, investment activity, as you've heard from the ESR Australia team, investment activity is muted. The markets are not only adjusting for the sharp rises in interest rates and debt costs, but also, and particularly for office, to the lingering hybrid working theme that seems to be pervading particularly the East Coast office markets. Moving to credit, China's isolation from real estate foreign investment and its deleveraging of its developers has created a bit of a liquidity squeeze that in turn is beginning to present some opportunities for credit investors. South Korea's market's presenting some really interesting opportunities where refinancing risk is high following there was some market gyrations caused by some high profile defaults in recent times. And in Australia, the stage is really well set for the non-bank lender to emerge. Traditional commercial banks are retreating from real estate lending. Sharp increases in interest rates and putting many investors under ICR and ultimately LTV pressure, and this is likely to play out over the coming months. So turning now to our key focus for the rest of this year. For private funds, establishing a real estate credit platform in the region with initial focus on Australia and New Zealand is front and centre for us. We then plan to roll that out into both China and Korea via separately managed accounts. We are seeing some good demand emerging for targeted and sector-specific separately managed accounts or SMAs across the region, as many global investors still remain underweight Asia Pacific and are starting to see the current opportunity as not a bad time to get set. As a group, we continue to position ourselves to take advantage of mispricing of high quality assets and pockets of distress that we expect to emerge in the coming year. And finally, with our investor operator model, we've continued to apply a highly intensive asset management program across the book to ensure the leverage positions are carefully managed and income security is enhanced. So with that, I will hand over to Kanish to take you through the infrastructure business. Kanish.
Thanks, David. Good afternoon, everyone. My name's Kanish Bhatia, Head of Infrastructure at ARA Private Funds. I would like to start by introducing ESR's first infrastructure fund, CAF. With an initial close of $1 billion, CAF is the largest ASEAN-focused private infrastructure fund in the market. The main anchor investor of the fund is Export-Import Bank of China. This fundraise represents a significant milestone for the ESR group. In line with the group's key growth pillars, it strongly positions us in the growing APAC infrastructure asset class. The resilience of infrastructure assets during times of economic downturn have greatly raised the attractiveness of the asset class, and we see global investors increasing their long-term allocation to the infrastructure sector. In line with these trends, we plan to upsize the CAF fund over time. In terms of the CAF fund mandate, we will invest in Southeast Asian countries across various transport, energy, and digital infrastructure sectors with a strong focus on sustainability and ESG standards. On this slide, I would like to highlight three areas: CAF's investment strategy focus, the infrastructure team, and our capital partners. Starting with the fund's investment strategy. It involves acquiring influential stakes in mid-market infrastructure assets, $50 to $150 million equity check per deal, where we see significant scope for expansion or operational improvement and value addition. We will primarily focus on brownfield expansion or growth platform assets. Target subsectors include transport assets such as roads, ports, airports, energy with a strong focus on renewables and energy transition, water, waste-related utilities, and telecom infrastructure assets such as towers and data centers. In terms of target countries within Southeast Asia, our primary focus will be Indonesia, Philippines, Vietnam, Thailand, and Malaysia. Other frontier markets we will look at on a more opportunistic basis. Looking at the team, to tap the growing infrastructure market opportunity, ESR has created a specialist infrastructure team. It consists of experienced investment professionals with a strong long-term track record of investing and managing various infra assets across Asia. The senior team members have on average 20+ years of infrastructure private equity fund management experience at various blue-chip institutions. This team can leverage ESR Group's significant corporate resources and extensive pan-Asia footprint and regional network. There are also various synergies and adjacencies between the infrastructure funds business and ESR's logistics, data center, and growing renewable energy development capability. With regard to our capital partners, in addition to China Exim Bank, the other capital partners of the fund include Gojoba Group, which is part of China Energy Engineering Corporation, a Fortune 500 company, and China Road and Bridge, part of CCCC, another Fortune 500 company and one of the largest EPC construction companies in the world. Moving on to the key infrastructure market themes and outlook. Big picture, we see significant opportunities in the ASEAN infrastructure market, given favorable macroeconomic trends and large infrastructure deficits in the region. Our fund's well positioned to benefit from robust long-term macroeconomic drivers in Southeast Asia, such as rising incomes, rapid urbanization, and favorable demographics. The ASEAN region is one of the fastest growing economic regions in the world, with GDP growth expected to be around 5% in 2023 and 24, according to ADB. Bain & Company estimates $2 trillion of infrastructure investment is needed in Southeast Asia over the next decade to support economic growth and mitigate climate change impacts. Having said that, despite the significant need for infrastructure investment, there remains a large funding gap as government budgets are stressed by ongoing inflationary pressures and pandemic impacts. All this creates tremendous opportunity for private capital and infrastructure funds such as CAF. The type of infrastructure deals we focus on will vary by country, as different ASEAN countries offer different market dynamics and regulatory frameworks. For example, in Vietnam, we're seeing a number of onshore wind, solar, and hydropower opportunities as cash-strapped local conglomerates are looking to reduce debt. The uncertainty around PDP 8-linked renewable energy tariffs is delaying investments, however. In Indonesia, we're seeing opportunities in the toll road sector, water treatment, and certain mining-linked infrastructure assets. This is driven to a large extent by privatizations and SOEs which dominate infra ownership in Indonesia, looking to sell assets to improve balance sheets. In Philippines, we're seeing a number of telecom tower assets, given recent liberalization and removal of foreign ownership limits, and also some midstream energy assets. Certain family-owned conglomerates, which have historically been very active in the infra space, are also divesting non-core asset-heavy infra assets or considering take-private offers. Moving on to our key priorities for APF infrastructure. Our main objective this year is to deploy CAF fund capital into high-quality, core-plus infrastructure and renewable energy assets. The team's actively sourcing and evaluating potential deals in the region, and we hope to announce our first infrastructure deal soon. While the team's focused on deployment, we've also started soft marketing with selected investors to upsize the CAF fund. In addition to the CAF fund series, we're also exploring the potential to establish a new APAC-focused sustainable infrastructure fund product focused on renewables. This will be a value-add strategy different from CAF's Core Plus mandate. I would like to end by outlining our overall vision, which is to create a multi-billion-dollar infrastructure funds business over the next few years with multiple products and strategies. We think this is achievable given the significant infrastructure market opportunity across Asia and growing investor demand for the asset class. ESR's move into the infrastructure business strengthens our competitive edge as a fully integrated one-stop solution for global capital partners and investors. Thank you.
Thank you,
Thanks,
David
Ganesh.
and Ganesh. Sorry, David?
Okay, over to you, Marilyn.
Yeah, thank you. So we've had, we've got a few questions coming in. Maybe we'll just start with the one for infra. Maybe Ganesh, you take first. So the first question we have is, what are ESR's plans to upsize CAF and grow the infra AUM?
Sure. Look, our immediate focus is on high-quality deployment for CAF. We're evaluating a number of opportunities, like I said earlier. We want to deliver the best risk-adjusted returns for our investors, but we do plan to upsize CAF over time. Like I said, our vision is to create a multi-billion-dollar infrastructure funds business over the next few years with multiple products and strategies. And in addition to the CAF fund series, we're looking to establish a new APAC sustainable infra fund. Other renewable funds are also in the works.
Okay. I think there's a second question for infra. What is the typical return hurdle for infrastructure projects?
See, it really varies depending on what stage of maturity the asset is in and what type of asset you're looking at. For instance, an early stage greenfield project will have different return requirements than a more mature core infrastructure assets with long-term contracts or regulated cash flows. So it really varies. There's a wide range. And within Southeast Asia as well, you have more mature markets like, say, Singapore, and then you have more frontier markets like Cambodia. So it's very hard to have one sort of set return hurdle.
Understood. Okay, the next question would be for David. So David, the question here is, over 50% of the AUM for ARA private funds is in office. Could you talk a little bit more in terms of the performance of the office asset class? Just some guidance in terms of the performance as well as values.
That's a big question. Happy to talk about office. Look, there's no question that office as a sector is facing probably the greatest fundamental change in demand that I've seen in 40 years in this business. And the managers who are going to do well are going to be those that adapt their properties to be fit for purpose. And by being fit for purpose, you have to satisfy two main things. One is what the tenants actually want. In other words, they are looking for different things than they were 3-4 years ago, with greater emphasis on wellness, greater emphasis on amenities, and you've got to provide a healthy building in a great location. The second line is it has to be sustainable. Many employees, rightly so, are very focused on how much energy consumption a building uses, and really don't like operating in clunky buildings that absorb more than their fair share of energy. So you've really got to have a building that is suitable for the tenants. The end of trip facilities now are a given. 5 to 7 years ago, they were exceptions to the rule. Now you really can't lease a building without it. So I think going forward, there's going to be those that satisfy these demands from the tenants, and ultimately there'll be demands from the investors as well, and those that don't. And there'll be a massive pricing difference between the two, in our view. So one of the advantages of the investor operator model is that we're hands-on in making sure our buildings are highly efficient, highly sustainable, and fit for purpose.
Okay. Okay, thank you,
I might
David.
stop there, otherwise I'll talk all day on on the office sector.
Okay, actually, yeah, I wanted to apologize as well. I think I inadvertently cut you off earlier in terms of some of your concluding points. So maybe I'll just hand that time over to you.
Okay, well, look, thank you. All I was really going to say was that we've given you a really whirlwind tour of the private funds business, both real estate and infrastructure. But I think it's fair to say that the infrastructure business represents one of the greatest opportunities in the region for the group that we've seen for a long time. And we're very excited about the prospects for the infrastructure business in the coming years.
Okay, I think that's all the questions we have. Thank you, gentlemen.
Thank you.
Thank you.
Okay.